In this video, I want to explain a conceptual point about how the flow of the financial statements works, and particularly this particular line item of retained earnings. You can see that on the balance sheet here, this is Costco's balance sheet. We see that in order to make the assets, so we have total assets here, equal to the total liabilities and equity, this line item of retained earnings is there. So what I'm going to do in this video is make sure that we are fully understanding what is baked into this retained earnings number. Um, as you're going to see, it's actually the total accumulated history of kind of the retained earnings of this company, starting from the very beginning of it. Okay, so even though this is, the balance sheet for September 2023, within this retained earnings balance, it's the history of all of the retained earnings all the way back to when Costco first started. So um, it's kind of the rolling, kind of the running balance of the retained earnings. Okay, so um, there's a lot of information that's been condensed into this number, but it's necessary, again, to make this balance sheet balance. So let's just make sure we're understanding what's happening when we have retained earnings on the balance sheet. One more thing I'll point out, and this is kind of giving us a hint into what this retained earnings balance is. So this is the statement of equity for Costco. And within this statement, we have this particular column that's just tracking the retained earnings. So all these other um, columns here in this statement are the other equity accounts. So we have common stock, so this would track how much common stock they've issued, additional paid-in capital. These details we're going to cover later in the class, but really let's just focus on this retained earnings. So we have, they're giving us basically 3 years of information. We have 22 to 23, 21 to 22, and 20 to 21. And you can see that at the start of 2020, this is the retained earnings balance. And then we're adding net income, we're subtracting dividends, and we'll again learn about this repurchase of common stock, and we're getting an updated balance. And then we're just repeating it for the next year, and we're getting an updated balance. And then we're repeating it again. And this is the balance that appeared on the balance sheet. So you're getting a hint that this balance is, taking the previous year, updating it. The previous year is the year before that, updated for that year, so on and so forth. So this balance here is basically the running balance for all the previous years. Okay, so let me open up a spreadsheet and we'll kind of look at this in more detail to make sure we understand what's going on. Okay, so here I have a very simplified income statement, and I've also added in how much dividends were paid. And we're going to see what these numbers mean in with respect to retained earnings. So I'm just going to fill in some formulas here. So the net income is the revenues minus the expenses. And then what I'm going to do is apply this because it's the same formula. So we can see here that we had some years that were losses, right? It's the same formula. We had more expenses than revenues. So in a couple years, we had losses. We're paying out a dividend every year. So we're going to assume that this year one is the first year that this company has been operating. So it's the first year. There's no kind of starting balance. This is the first year. And so what the retained earnings is you can say there's a zero balance. I'm not going to write it, but just, since again, this is the first year of the business, there's no starting balance for retained earnings, but we're going to add the net income. And we're going to subtract the dividends. So for the year one balance sheet, we would have to have this $15 of retained earnings to make the balance sheet balance. And that is incorporating basically what happened on the income statement, how much we paid out in dividends. And so this is kind of what we need to uh, complete the balance sheet with respect to the equity section. Okay, so in the next year, what we're going to do is we're going to take the starting balance. So this is, year one, this is what happened during the year, but at the start of year one, we had a retained earnings balance of $15. We're going to add the net income of this year two, and we're going to subtract the dividends we paid in year two. So you can see that we've updated this retained earnings, uh, given what's happened in this year two. And so if we continue this formula, you can see every year. So if we were doing, if again, the company, when they present their financial statements, is only going to show year four. They're going to show the revenue from year four, the expenses from year four, and the net income from year four, and how much dividends they paid in year four. But to get the proper retained earnings balance, they have to incorporate the balance from the previous year. And the previous year's balance includes information from all the other previous years. So again, this is kind of like a running balance. So to update the year four retained earnings, we start with the ending balance from year three, and then we are adding the net earnings, the net income, sorry, which again is a negative number in this case, so it kind of is reducing the retained earnings balance, and also the dividend is also reducing. So you can see that's why the retained earnings balance dropped in year four, because we had a loss and we paid a dividend. So it's going to kind of eat into this accumulated balance. Okay, so how can we recreate this? Um, if you added up all of the revenue since the beginning of time, and we did the same thing for the expenses, and then we also added up all the dividends that we paid, my contention is that we're going to end up with this same ending balance. So let's see if that's the case. So we take the net income. This is the lifetime net income. So this, if we presented these numbers in a financial statement, it would be like whatever, 2020 to 2025. No company does that, because what investors and financial statement readers really care about is just what's happened most recently, in the most recent, usually 12-month period. If you had a company like Coca-Cola, that's been around for, I don't know, 100 years, you don't want to have a financial statement that's like 2000 or 1925 to 2025. Your financial statement readers are not going to find that useful. But I'm just doing this to illustrate that actually you'll get to the same ending result for retained earnings. So again, I'll take the net income, subtract out the lifetime dividends paid, and you can see here that if we did this lifetime kind of income statement and dividends, we get to the same balance for retained earnings. So I just again want to illustrate this is related to the idea of financial periods. When we're just presenting this particular period, say year five, we're going to have starting balances, which are, um, you know, the cash, all your balance sheet accounts will have a starting balance, and also retained earnings will have a balance. And this number gives you all this previous information condensed down, netted against each other. But like if I knew that the retained earnings was $22 in year four, I wouldn't be able to say what the revenues were in year one or year two or year three, or how much dividends we paid. I just know kind of the net effect of everything. So for example, if I change this to, 420 and 400, I wholly changed the revenues and expenses, but I still have the same kind of result for retained earnings. So you can't go backwards with retained earnings, but you can go forwards. Like we took all this information to get this number. So it's kind of collapsing all this stuff, all the revenues, expenses, dividends, netting it all together and giving you a balance. So it does contain all the history of the company, but just in a condensed form, netted into one number. Okay, so hopefully you understand how this is related to kind of financial statement periods, closing process, because we're basically kind of updating the retained earnings balance at the end of the year to add in the net income and kind of subtract the dividends to get the ending balance for retained earnings. And then that is the balance that carries over to the next period.